Welcome to this edition of Wealth Insights. I'm Lisa Leiter. This month we decided to focus on closed-end funds. They can be considered a complicated area of the market, but one that can offer good income and opportunities for investors. And this market is by no means small. At the end of March of this year, there were 644 closed-end funds with almost $200 billion in total assets. Joining me now to talk more about closed-end funds is Patrick Galley. He's the Chief Investment Officer at RiverNorth Capital Management here in Chicago. Patrick, thanks for joining us.
Thanks, Lisa.
So I guess the first question we should start with is, what is a closed-end fund?
A closed-end fund is very similar to an open-end mutual fund, which a lot of investors have in their retirement accounts and buy at Fidelity, TD, etc. The major difference, though, for a closed-end fund is that there's a fixed number of shares issued at an IPO. So in that respect, it's very similar to a stock. This fixed number of shares that gets issued means that the price of the security can trade at a premium or a discount to its actual net asset value, which is the liquidation value of the underlying assets.
And typically, these do trade at a discount. There are a lot of reasons that experts argue about as to why that is. In your opinion, why do they typically trade at a discount?
We believe there's one very logical reason that they trade at a discount to their net asset value. Because there is no structural feature that's similar to an ETF where you can arbitrage if it does trade at a discount, where you can actually redeem and get to the underlying assets. That doesn't exist in a closed-end fund. So because there's a risk that it can trade at a discount, means that investors should be compensated for that risk, and they should be only willing to pay a discount for that security.
And even though most of them are trading at a discount, there is a percentage of them right now, about 20%, trading at a premium. What's going on there?
Investors, I think, feel pretty late to the game. The market has gone up 50% off its March 9th lows. As investors are trying to put money to work, they had a lot of money on the sidelines. When they continue to put that money to work, they're looking for yield predominantly. And so closed-end funds a lot of times have a higher yield associated with them because they utilize leverage in their capital structure. And so when they're looking at closed-end funds, the first thing and foremost, they're looking at the yield, which is probably not the right way to look at it. And so when they're looking at this yield, they are investing in the closed-end fund. That's going to a higher premium, and then it becomes a self-fulfilling prophecy. At the higher the premium, investors are looking, wow, this is going up even more. Plus, I'm getting a great yield, and the premium keeps on expanding.
And are there certain types of funds that are typically trading at a premium right now?
Yeah, funds that exhibit actually high distribution rates. And I should clarify that distribution of the income of a closed-end fund does not always equal the yield. A lot of closed-end funds return capital, and so investors are not even getting income from the closed-end fund in the respect that we look at a bond. But it's just actually a return of their own capital. So if they make an investment for a closed-end fund, they might be buying a dollar's worth of assets and paying $1.50. And then when they get the distribution back, it's actually a return of their capital, and the fund's not even kicking off income from the underlying assets.
I was surprised to see that there were twice as many bond closed-end funds as there were stock funds. What's the primary reason for that, and do you expect to see more stock closed-end funds in the future?
Approximately 640 closed-end funds are in existence today. Of that, approximately 230 of them are municipal bond closed-end funds, and then there's another 200 or so that are other fixed income securities. The predominant reason that there's fixed income closed-end funds more than equity is because they're sold to retail investors at IPO, and investors like yield. They want that distribution stream, and so fixed income fits that bill. And then also you can put leverage in top of in the capital structure of a closed-end fund. And when you do that, obviously your yield goes up, investors are more happy, so it's easier to be sold at IPO.
So at this point then, if you're a new investor to closed-end funds, what sectors do you think provide the most opportunity for them?
The sector that probably provides the most opportunity today is actually the equity asset class. So equity closed-end funds are trading at very wide discounts to their historical averages. You can pick up regular closed-end funds in the equity asset class at 15–20% discounts, and you're not going to get anything necessarily too scary. You got great managers out there managing these funds, and we think it's a great opportunity versus the fixed income is trading quite narrow today.
What kind of investor do you think is best suited to a closed-end fund?
An investor that's relatively astute to the financial markets, because there are certain risks. What the investor that probably is not best suited is an investor that's not going to look under the hood and see actually what is in the closed-end fund. Is there leverage involved? Where is the historical discount? A lot of investors don't even realize that there is a discount or a premium perhaps associated with a closed-end fund. So you really need somebody that's going to be willing to look at financial statements and perhaps scrub the web to see if they can get other information for those closed-end funds.
And these are primarily sold through financial advisors right now, right? I mean, only a very sophisticated investor would be buying these on their own?
That's correct, yes. Typically, at IPO, it's financial advisors that raise the bulk of the assets at IPO. After they're trading in a secondary market, then you do get institutional investors, you do get retail investors. By our studies, we believe only 20% of the investor base is institutional. That provides obviously a lot of inefficiencies in the marketplace and gives us the opportunity to compete against the retail investor, if you will.
Now, we've talked on this program before about exchange-traded funds and the inroads that they're making into 401k plans. Is there any chance that closed-end funds might make their way into a 401k plan?
We don't think so, because closed-end funds are very similar to a regular stock in that it trades on an exchange. It's just a registered investment company that trades like a stock. And so investors really, there's no incentive to equitize or daily unitize that value of a closed-end fund and put it in a 401k plan for investors.
Okay. Anything else you want to add?
As far as closed-end funds go, we do think they're a great opportunity for investors to pick up, additional yield at a discount, additional total return at a discount. And so anytime you can buy a dollar's worth of assets at, let's say, 85 cents on the dollar, we think that's obviously a pretty good value.
You said you saw a lot of opportunity for investors in equity closed-end funds, so
Right.
That makes me want to ask you what your short-term outlook is for the stock market right now.
Right. We believe equity closed-end funds offer a great opportunity because they're trading at wide discounts. Usually that's a sentiment indicator, meaning that other investors are disenchanted with the equity markets then. And so anytime, we're contrarian investors, so anytime we see funds trading at discounts, typically it's an out-of-favor asset class. Even though we're off 50% off our lows, we believe that the equity markets at this point are fair valued, but there's a lot of cash sitting on the sidelines getting put to work, and that especially these equity closed-end funds trading at deep discounts, value investors will put money to work in those space and push the discounts narrow.
How about the bond market? Have we seen the lows we're going to see on interest rates?
On interest rates from a treasury perspective, yes, we believe so. But as far as the high yield in the investment grade bond market, we believe the spreads are very attractive still.
Okay. Well, Patrick, thank you so much for joining us today. We
Thanks,
appreciate
Lisa.
it.